Accounting, What the Numbers Mean. 9E. Chapter 2, Financial Statements and Accounting Concepts and Principles. Learning Objectives. To understand 1. What transactions are. 2. The kind of information reported in each financial statement and how financial statements are related to each other. 3. The meaning and usefulness of the accounting equation. 4. The meaning of each of the captions on the financial statements illustrated in this chapter. 5. The broad, generally accepted concepts and principles that apply to the accounting process. 6. Why investors must carefully consider cash flow information in conjunction with accrual accounting results. 7. Several limitations of financial statements. 8. What a corporation's annual report is and how it is issued. 9. Business practices related to organizing a business, fiscal year, par value, and parent-subsidiary corporations. Learning Objective 1. Understand what transactions are. The term economic interchange means that something of value has been given up by one entity in exchange for something else of equal value. For example, an organization uses cash to pay for employee wages. The organization gives up cash to pay an employee to produce a product, while the employee gives up time to produce the product and in exchange receives a wage for his or her labor. Transactions are economic interchanges between entities that are accounted for and reflected in financial statements. Examples include borrowing cash from the bank, sales of merchandise, purchases of inventory, cash receipts for goods sold, and cash payments for supplies and merchandise. Recording transactions, the economic interchanges between an entity and other organizations and/or individuals, requires both bookkeeping and accounting functions. The flow begins with the bookkeeping function, procedures for sorting, classifying, and presenting the transactions, and continues with an accounting function of selecting among alternative methods of reflecting the effects of those transactions. The entity's financial statements are the end product of these processes. Transactions are summarized in accounts. Accounts are used to organize like-kind transactions, just like file folders are used to organize information stored in a file cabinet. Account balances are then used in the preparation of financial statements. Learning Objective 2. Understand the kind of information reported in each financial statement and how financial statements are related to each other. The four financial statements include 1. The balance sheet, that presents the financial position of an entity at the end of an accounting period. 2. The income statement, that reports the earnings of an entity for the accounting period. 3. The statement of cash flows, that shows the cash inflows and outflows during the period. And 4. The statement of changes in owner's equity, that reports the investments and distributions to owners during the period. These financial statements are contained in an annual report that will probably include several notes or explanations of the accounting policies used and detailed information about the amounts and captions shown in the financial statements. Learning Objective 3. Understand the meaning and usefulness of the accounting equation. The balance sheet is a listing of an organization's assets, liabilities, and equity at a point in time. Assets represent the amount of resources owned by an entity, the probable future economic benefits obtained or controlled by the entity as a result of past transactions or events. Liabilities are those amounts owed to other entities, the probable future sacrifices of the entity's economic benefits arising from present obligations to transfer assets or provide services to other entities in the future as a result of past transactions or events. Owner's equity is the owner's right in the assets of an entity that remain after deducting the liabilities. Owner's equity is often referred to as net assets. Assets minus liabilities equal owner's equity. Current assets are those assets that are likely to be converted into cash or used to benefit the entity within 1 year. Current assets include cash, accounts receivable, and merchandise inventory. Current liabilities are those liabilities that are to be paid within 1 year. Current liabilities include short-term debt, accounts payable, and other accrued liabilities. Assets equal liabilities plus owner's equity. The balance sheet equation must balance. Total assets include current and long-lived assets. Total liabilities include both current and long-term liabilities. Total liabilities combined with owner's equity must equal total assets. Learning Objective 4. Understand the meaning of each of the captions on the financial statements illustrated in this chapter. The income statement shows the profit for the period of time under consideration. The income statement may be called the statement of earnings, profit and loss statement, or statement of operations. The income statement reports the revenues that result from the entity's operating activities and deducts the costs and expenses incurred in generating the revenues to arrive at net income, which represents the profit or loss for the period. The income statement also reports the earnings per share of common stock. Net income divided by the average number of the company's shares of common stock outstanding. The income statement also reports gains and losses for the period under consideration. Gains and losses result from the non-operating activities of the entity rather than the day-to-day operating activities that generate revenues and expenses. The statement of changes in owner's equity reports the details of owner's equity and explains the changes that occurred in paid-in capital and retained earnings during the year. Paid-in capital includes common stock at par value and additional paid-in capital. Retained earnings include the net income or loss reported by the entity since its inception, less any dividends that have been distributed to owners. This statement provides the details of the balances reported in the owner's equity section of the balance sheet. The statement of cash flows details the inflows and outflows of cash during a period of time, which is typically 1 year. The inflows and outflows of cash are separated into 3 distinct categories. 1. Operating activities, 2. Investing activities, and 3. Financing activities. Cash flows from operating activities consist of inflows and outflows of cash required to operate the business on a day-to-day basis. Inflows result from selling products or services. Outflows result from paying expenses required to generate revenue, such as wages, rent, utilities, etc. Cash flows from investing activities result from the organization using cash to purchase long-term assets such as equipment, building factories, or purchasing land. The long-term assets are acquired with the intention of increasing revenue. Inflows typically result from the sale of long-term operational assets. Cash flows from financing activities typically include the borrowing or repayment of monies. Cash inflows from financing activities may come from investments from stockholders or the borrowing of funds from bondholders or a financial institution such as a bank. Outflows from financing activities may result from the repayment of previously borrowed funds or the payment of cash dividends. The beginning balance sheet reports the assets, liabilities, and owner's equity account balances as the accounting period begins. The income statement reports the revenue earned and expenses incurred during the year. The net income is calculated and reported in the changes in owner's equity, and the net income is added to the beginning balance in retained earnings. Dividends are deducted at this time as well. The ending balance in owner's equity is reported on the end-of-year balance sheet. In addition, the statement of cash flow shows the increase or decrease in the cash account, which is combined with the beginning balance Then the calculated balance is reported in the asset account cash in the ending balance sheet. Earning revenue always increases owner's equity. Incurring expenses will always decrease owner's equity. Expenses are necessary in order to generate revenue. Dividends will also decrease owner's equity, however, they are never treated as an expense. Expenses are defined as costs associated with generating revenue. Dividends are never considered an expense because they reflect a distribution of profits from the organization to the investors. The payment of dividends to investors has no correlation to the generation of revenue. This is a golden rule of accounting discussed in the conceptual framework that should never be ignored. The income statement reports net income, and net income affects retained earnings, which is one component of owner's equity. If assets equal liabilities plus owner's equity, when assets equal $300,000 and liabilities equal $125,000, what is the amount of owner's equity? Owner's equity equals $175,000. $300,000 minus $125,000. Given that assets equal liabilities plus owner's equity, suppose that total assets increase by $12,000 and total liabilities decrease by $3,000 during the year. What is the amount of owner's equity at the end of the year? First, solve for the change in owner's equity during the year. If assets increased by $12,000 and liabilities decreased by $3,000, then owner's equity must have increased by $15,000. $12,000 plus $3,000. Next, combine 1. The assets, $300,000 plus $12,000 increase for a total of $312,000. 2. Combine the liabilities, $125,000 less $3,000 decrease for a total of $122,000. And 3. Combine the owner's equity, $175,000 plus $15,000 for a total of $190,000. The balance sheet presents the balances in an entity's accounts at a given point in time. The current asset accounts on the balance sheet include cash, accounts receivable, and merchandise inventory. Non-current asset accounts on the balance sheet include equipment and the contra account to equipment accumulated depreciation. The liabilities on the balance sheet include current and long-term liabilities. The current liabilities on a balance sheet include short-term debt, accounts payable, and other accrued liabilities. Long-term liabilities include long-term debt. Owner's equity accounts on the balance sheet report the residual claims of the owners to the assets, which is also represented as assets minus liabilities. The balance sheet is one of the 4 reports that are typically generated by an accounting information system. The balance sheet reports the ending balances of all assets, liabilities, and owner's equity at a specific point in time. At a minimum, an organization will produce a balance sheet at the end of its accounting year. However, some organizations will report these results at other intervals throughout the year, typically quarterly. Internally, an organization may decide to produce this report monthly depending on its information requirements. The income statement captions include net sales, sales minus returns, cost of goods sold, the cost of merchandise removed from inventory and sold to customers, and gross profit, net sales minus cost of goods sold. Selling, general and administrative expenses, also known as operating expenses, are deducted from gross profit to arrive at income from operations, an important measure of the firm's activities. Interest expense, the cost of borrowing funds, and income tax expense, which is calculated after all other items have been reported, are deducted from income from operations to arrive at net income. Net income per share of common stock outstanding, which is net income earned divided by the average number of shares of the entity's common stock outstanding, is often referred to as earnings per share, or EPS. The income statement captures revenue and related expenses in generating revenue. It typically measures profit or loss over a period of time not to exceed 1 year. Some organizations will generate this statement monthly or quarterly to assess how the organization is performing and/or meeting its objectives. The statement of changes in owner's equity reports paid-in capital, the total amount owners have invested in the entity, which includes common stock, the number of shares authorized, issued, and outstanding. Outstanding means the shares still held by the stockholders. The retained earnings account reports the cumulative net income of the entity that has been retained for use in the business minus the dividends, which are distributions of earnings to owners. This statement reflects the changes that have occurred over a period of time with owner's equity. Each shareholder is considered an owner of the organization and therefore has the most interest in this financial statement. The statement of changes in owner's equity is considered a supplemental statement to the balance sheet. The balance sheet reports the equity section at a point in time, while the statement of changes in owner's equity details the changes that occurred throughout the accounting period affecting this portion of the balance sheet. The statement of cash flows includes 3 captions, referred to as activities. The first caption, Cash Flows from Operating Activities, begins with net income from the income statement. Then, 1. Adds back depreciation expense because it is subtracted to arrive at net income but does not require the use of cash. 2. Deducts an increase in accounts receivable because it reflects sales revenues that are included in net income but not yet received in cash. 3. Deducts an increase in merchandise inventory because cash was spent to acquire the increase in inventory. And 4. Adds an increase in current liabilities because cash has not yet been paid for the products and services that have been received during the current fiscal period. The caption, Cash Flows from Investing Activities, shows the cash sources and uses related to long-lived assets. The caption, Cash Flows from Financing Activities, shows the cash sources and uses related to transactions with creditors and stockholders. The statement of cash flows is another supplementary statement. As an asset, the ending cash balance is reported on the balance sheet. This statement recaps the sources of cash and how cash was used throughout a period of time, typically 1 year. One key number to watch on this statement is whether the cash flows from operating activities are generating positive or negative results. Over time, an organization should have a positive cash inflow from operating activities. If an organization consistently generates a negative cash inflow from operating activities, it is an indicator of trouble. Cash is mandatory to continue operations. When cash flow from operating activities is consistently negative, it translates to financing activities. Consistent borrowing to fund day-to-day operations will ultimately cause an organization to go bankrupt. Learning Objective 5. Understand the broad, generally accepted concepts and principles that apply to the accounting process. Broad concepts and principles of accounting that have become generally accepted for financial accounting and reporting purposes include 1. The accounting entity concept, a term that refers to an entity for which financial statements are prepared. Every economic entity can be separately identified and accounted for. 2. Going concern concept, a presumption that the entity will continue to operate in the future. It is not being liquidated. 3. Unit of measurement principle, a requirement that only transactions denominated in dollars are recorded in the accounting records. And 4. The cost principle, which requires transactions to be recorded at their original cost to the entity as measured in dollars. Other concepts and principles include 1. Objectivity, a concept that refers to the accountant's desire to have a given transaction recorded in the same way in all situations. 2. Accounting period, a concept that relates to the period of time selected for reporting results of operations and changes in financial position. 3. Matching concept, a concept that requires all expenses incurred to generate an accounting period's revenues be deducted from revenues earned in that accounting period. And 4. Accrual accounting, a concept that recognizes revenue at the point of sale and recognizes expenses as they are incurred, even though the cash receipt or payment may occur at another time or in another accounting period. Other concepts and principles include 1. Consistency, which assures meaningful trend comparisons over several years. Consistency is the concept that makes it inappropriate to change from one generally accepted alternative method of accounting for a transaction to another method without explicitly describing the change in methods and its effect on the financial statements in the notes to the financial statements. 2. Full disclosure, which requires that circumstances and events that make a difference to financial statement users should be disclosed. 3. Materiality, cost-benefit relationship, which means that the benefit of increased accuracy should outweigh the cost of achieving the increased accuracy. And 4. Conservatism, a principle that requires accountants, when in doubt, to make judgments and estimates that result in lower profits and asset valuations. Learning Objective 6. Understand why investors must carefully consider cash flow information in conjunction with accrual accounting results. Differences between accrual accounting and cash flow. The matching concept. The rules of accrual accounting state: 1. Revenue is recognized at the point in time that a service or product is delivered to another entity. In other words, an economic exchange of value between two entities. 2. The exchange of cash is not required to recognize revenue. If the product or service has been delivered to the customer, revenue must be recognized. 3. Expenses are recognized at the point in time incurred. Cash does not need to be disbursed in order for an expense to be recognized. For example, your electric bill for the month of May is not received from the electric company until June and will be paid in June. The cost of the electricity for May is directly related to revenue for that month and needs to be reflected as an expense for the month of May. 4. The matching principle of accounting dictates that all expenses related to generating revenue for a given accounting period be matched to the same accounting period, regardless of when cash changes hands. Cash flow recognizes revenue when payment is received for services rendered or products sold, and recognizes expenses when they are paid. Learning Objective 7. Understand several limitations of financial statements. Financial statements have limitations. These limitations include 1. They report only quantitative economic data, and 2. They do not reflect qualitative economic variables, such as the value of the management team or the employees' morale. Qualitative economic variables are usually subjective in value and cannot be quantified in terms of dollars and cents that can be verified. Assets are always valued at historical cost. One good example of the historical cost concept relates to land. Suppose an organization purchases land today at a value of $100,000 with the intent of building a factory on this land. In most cases, land always increases in value. Assuming that the factory is not built at the end of the year, how should the land be valued, given that over the year, other properties in the area are now selling for $200,000? The answer to this question is that the value is determined when a buyer and seller agree upon a price for the item at time of sale. Organizations cannot revalue their assets on the balance sheet. Estimates are acceptable to incorporate into financial statements as long as a solid, verifiable basis exists. As an example, an automobile manufacturer could warrant a vehicle to be free from manufacturing defects for 1 year from the time of sale. Reviewing prior warranty claims might reveal that 1% of all auto sales during a given year resulted in warranty claims. Based on the matching principle, it is reasonable to record an expense and corresponding liability for the anticipated cost of vehicle repairs covered under the warranty. Learning Objective 8. Understand what a corporation's annual report is and how it is issued. A corporation distributes an annual report to its shareholders. The annual report contains the financial statements together with the report of the external auditor's examination of the financial statements. It also contains management's discussion and analysis, MD&A. End of Chapter 2.